Good morning. Welcome to Stock Market Today. It's Tuesday, July 7th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. You can sign up for a free email where I get a lot of the content for this show. It also gives you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities were higher in quiet Monday's trading, finishing near the best levels of the day. The NASDAQ outperformed while small caps lagged. At the sector level, consumer discretionary and comm services led, while utilities were the only sector to finish lower on the day. Treasuries were mostly weaker. The dollar was down on the major crosses. Gold was up 20 basis points. WTI crude was little changed on the day. As we get to the desk this morning, futures are down about 90 basis points after Asian equities were mostly lower overnight, with Hong Kong and South Korea lagging. China did extend its recent outperformance. European markets are under pressure. Treasuries are unchanged to slightly stronger, with the curve flattening. The dollar is outperforming against the yen and the euro. Gold is down 60 basis points, and WTI crude is off by about 1.5% to get us going on a Tuesday morning. Following a Monday trading day that saw a rally into the gap, which remains open for now, right? So here's that downside gap that opened in early June. We're trying to close it. We did finally break above near-term resistance, or the bottom end of a near-term resistance zone at 3150. So, 3,000 to 3,100 largely remains support. 3,150, 3,250. Is that range that is resistance in the near term. So as long as support is holding, the February highs are in play. Should 3,000 break, and 3,000, as I've said, is an important level as it lines up with moving averages, both the 50 and 200 days, psychologically important round number. Should support hold, I think we're still open for an attack on the February highs. However, if it does break down, we have to start thinking about downside to the 2850 level and what that could mean for markets. Now, we've left oversold conditions based on that 13-period CCI, and working towards overbought levels. Chaikin money flow continues to fade here in the near term. So that's the structure of the market as we enter trading on Tuesday morning. Taking a look now at our market in a minute. What are we writing about in our note to Chaikin Analytics clients? Well, we rallied, but the SPY has work to do with that June gap. Consumer staples continue to fade on a relative basis. To me, that's largely a bullish sign, as that's a defensive group, and consumer discretionary breaks to new relative highs. Growth is leading outside the U.S. as well, and futures point, as I said, to a lower open here today. Now, if we dig in on the major indices from a power bar perspective, now all of the major indices were higher yesterday. The Dow added 1.7%, 5 bulls to 7 bears, so an improvement on the ratio there. S&P 500 up 1.5%, sees an improvement as well, 102 to 96, shifting actually to the bullish side of the coin. NASDAQ up 2.5%, 34 to 8 bulls to bears. Small caps lagged on the day, only up 70 basis points or 77 basis points, but still with a bullish ratio at 583 to 301. Bonds down, tick, sending yields higher. Consumer discretionary had a strong day, largely led by Amazon. The group added 2.37%. Amazon was up over 5% on the day, 9 bulls to 19 bears for the ratio in the consumer discretionary space. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes are mixed. Let's hit our stock of the day now. As I said, and as I highlighted in my note today, consumer staples continue to weaken. And one of the stocks that I'm highlighting there is Campbell Soup, right? CPB, the ticker symbol there, closed at 49.31 yesterday. Has a bearish Chaikin Power Gauge rating, is in a weak trend below the long-term trend line. Now, the food products group is strong, but this is a stock that we likely want to avoid or potentially look for bearish opportunities. And the setup here is fairly straightforward. It's kind of just the reverse of what we talk about when we look at bullish setups, right? We have a bearish stock that is underperforming the market, and it appears that the intensity of that underperformance has been picking up of late. Stock is overbought based on our overbought, oversold indicator, with the indicator rounding lower within that overbought condition. As Chaikin money flow has been bearish for the past month and a half or so. So to me, that tells me at the very least, this is a stock we don't want to own. Or if you do trade to the bearish side of the coin, this is a weak stock within a sector of the market that continues to show relative weakness. And we'll look at the chart of Staples against the broader market a little bit later on in the show. But the stock of the day today, Campbell Soup, as a potential bearish idea, or at the very least, a name that we want to avoid. As we dig in now on the sector tracker, movement over the last 5 days is largely bullish, as all sectors are higher over the past 5 days. And it's led by kind of the type of leadership you'd want to see if you are bullish the market, right? Comms, nice rebound after that knee-jerk move lower on the heels of advertisers pulling away from social platforms. Comm services holding support and seeing a rebound. Discretionary, granted, Amazon is a huge weight there, and they had a big day yesterday, but those are the facts. Discretionary is towards the top of the list. Materials, of all the areas of the market that point to the potential for a reflation type trade, I think materials sets up the best, and tech rounds out the top 4 groups that are of the list. Healthcare, REITs, and financials are middle of the road. At the bottom, kind of lagging over the past week of trading, industrial staples, utilities, and energy. You know how I feel about energy. The utilities, again, that speaks to the fact that, and staples as well, these defensive groups are underperforming. So that does speak to the odds of support holding at that 3,000 level being somewhat higher than I would give them credit for if groups like staples and utilities were actually outperforming. So that's just something at the sector level that we're watching. Our note today does a deep dive on all of the sectors and how they're performing on a relative basis, both from a trend perspective as well as in the short term. Our industry in focus today, this is one we actually touched on last week. It's healthcare equipment services, which has been an outperformer over the past 6 months, leading the S&P 500 by about 9.5%. And the power bar ratio, which looks at future potential, is strong. 17 bullish stocks for 12 bearish stocks, currently ranked 13 of 21 subsectors. It's moved up 2 slots over the past week. So some of the names there that might warrant some attention on as a potential long idea: Lantheus Holdings, LNTH, LivaNova, LIVN, and Axogen, AXGN, all have very bullish Chaikin power gauge ratings. And as if we look here at the ETF that measures the group, the ticker symbol there, XHE, we see a fund that has a bullish rating to go along with that bullish ratio. Strong trend above the rising long-term trend line, and a topside breakout through resistance. This fund traded at a new 52-week high yesterday. So if I wanted to kind of poke holes in it here in the near term, what I would say is I don't love seeing bearish money flow on a stock or an ETF that's trading near a new high. Add to that the fact that the fund is overbought here in the near term. So near term, don't necessarily think I want to chase a group like this or chase this particular ETF. However, bigger picture, strategic perspective, we are breaking the new highs. It's outperforming. So we have a bullish fund outperforming the market. Near term, a little bit dicey. I'd love to see a consolidation that holds above this $90 breakout level that then sets the stage for opportunities within this somewhat offensive area of the market. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers, the gainers and losers on the day. Freeport-McMoRan provided an update rather on their 2020 operating plans. That stock was higher by nearly 11%. It was a recent bullish call out in one of our notes about a week and a half ago. Xilinx was added to the conviction buy list at Goldman Sachs. That sent the stock higher by 7.15%. Chipotle got a positive mention in Barron's over the weekend. That led to 6%, 6.5% to the good. FTI, nothing company specific there, leading to a 6% pop in the stock. And there's Amazon up 5.75% yesterday as the internet group was strong and money continues to flow into these mega cap fan mag stocks. On the loser side of the board, OKE, nothing company specific there. Letter D is a bearish rating. They're selling a unit to Warren Buffett. Had to take down some numbers, down 11% on the day. Leidos, nothing company specific, down 5.5% yesterday. They are out on the tape this morning. with news of a new order. DXC giving back some strength. Stock was higher by about 16% last week. And Dollar Tree, DLTR, down 4% on the day. Didn't see anything company specific driving trading there. And we are getting close to earnings season, right? So another week or so, we'll kick off earnings season. So for this week, I don't expect a lot in the way of company specific news, but that will change in short order as earnings season kicks off next week. So let's look at the trends now on a relative basis, right? Tuesdays, I dig into the sectors and see what's leading, what's lagging, what trends are likely to persist, right? So if I look at something like XLP, this is consumer staples relative to the S&P 500, and what I see is a fresh breakdown through near-term resistance for the ratio as it trades below the declining 200-day moving average. At the same time, if we take a look at the RSI of the ratio, it's been trending lower, and it appears to have shifted into bearish ranges, indicating that momentum is with that trend, right? So what does this mean bigger picture? I mean, this is largely a defensive group, right? You can see that on a relative basis, they began to lead, right, as the market sold off in the back half of February and really saw a sharp spike into the market's lows on March 23rd. And subsequently, as the market has rallied, this group has now begun to trend lower, and we get a fresh breakdown through support, right? So that's a bullish sign for the market in general, right? If we have the offensive areas of the market, like tech, like discretionary leading, while the defensive areas of the market, such as utilities and staples, are underperforming, that largely points to odds favoring support holding for the S&P 500. Now, remember, the S&P 500 is 500 stocks, very heavily skewed towards those mega cap tech and consumer tech growth leaders. So just kind of keep that in mind as you talk about the market, talk and think about stocks. Ask yourself, what am I really looking at here? And drill down on the index. If we take a look at the bottom of the chart, we can see staples largely mimicking the broader market, kind of churning sideways here, trying to, back and forth in a near-term consolidation that's been in place since April to May. But it's the relative that I'm keying in on here today in my notes. And as staples break down through support, we have discretionary doing the exact opposite, breaking topside through resistance, XLY relative to the SPY here. So discretionary relative to the S&P 500, new highs on a relative basis, right? Again, largely a function of Amazon, right? Amazon is about a 25% weight in the discretionary sector. Amazon was up 5.75% yesterday. So you would expect the staples to put in a strong showing, which they did. The ratio is above the 200-day moving average. Now, in the near term, we do have a slight divergence in play that's caught my attention. It needs to be confirmed by a breakdown. So a failure to hold above this new breakout level would likely confirm this divergence. But for now, we're innocent until proven guilty on the divergence front. And if we take a look at the bottom of the chart, is just kind of that you can take a look at discretionary relative to staples, and this is cap weighted. A lot of times I'll look at this on an equally weighted basis to neutralize for Amazon, but on a cap weighted basis, the simple fact of the matter is Amazon is a holding, and if you're long XLY, you're benefiting from that dynamic, especially relative to consumer staples. So that to me is a little bit more of offensive positioning. And then finally, we've talked a lot about growth and the growth theme. And it's a theme outside the U.S. as well. Take a look at EFG, the iShares MSCI Europe, Australia, Far East Growth ETF. Also breaking out of this recent consolidation, has eyes towards its February highs. Neither overbought nor oversold, but take a look at the relative against the SPY. Breakout, pullback, and so far holding. So that growth theme starting to extend outside the U.S. That'll wrap us for today. Take us for a test drive, chaikinanalytics.com/test drive, free 14-day trial. I'll be back with you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.